Hi guys, it's Ian from Signal Centre. In today's webinar, I'm going to be talking about multi-timeframe analysis, quite an important feature of trading, I believe. We're going to turn to cover various different subjects. We're going to cover timeframes, different timeframes, what the majority of traders or analysts look at, and then look at some of the timeframes that people don't look at. We're going to talk about the out to in other words, we're going to start at higher timeframes and work backwards. We're going to talk briefly about A.M.R, that's known as an acute monthly reversal candle, and that just emphasizes the fact that we should be looking at these higher timeframes. And then we're going to look at trending, counter trending, or neutral. So we're going to look at breaking down just one currency pair in this webinar and just highlighting what I believe is the bias for each of those different timeframes to work out a trading plan for that currency pair. Obviously, this isn't just for currencies, it's for commodities, indices, stocks, any product that you can trade. Then we're going to put it into practice, and then we're just going to talk about what timeframes should I use. So, you know, what type of trader are you? What sort of timeframes are you looking at? You know, are you a scalp trader? Are you going all the way down to a 1 minute chart? So let's start with the most common timeframes, probably pretty basic and obvious to most of you. The weekly chart, the daily chart, then people break down 4 hours, hourly, 30, 15, and 5. Now, at the top here, we've got the daily and then 4 hour. It's a lot of analysts look to break down in quarters. I know that 4 times 4 is 16 and not 24, but as you break down further than that, it goes down in quarters. So you go 4 to 1 hour, and then most would go an hour to 15, and then most people will just don't really look at many time frames below 15 minutes. If we go to the next slide, these are the more uncommon timeframes: the monthly chart, the 3 hour chart, the 2 hour chart, the 45 minutes, 10 minutes, 3 minutes, and then the 1 minute time frame. I've put here all candle formations mean the same no matter what the time frame. Now, what do I mean by that? What I mean by that is an evening doji star on a weekly chart is a topping formation. It's still a topping formation on a 5 minute chart if you get an evening doji star, but the difference is the reversal will normally be a lot greater in a higher time frame and hold more power in a higher time frame than it will in the shorter time frame. Break time frames down from highest time frame to the shortest time frame. The higher the time frame, the more relevant. I've got a spelling mistake in there already. More relevant it is to the overall trend. So we start with a monthly chart, then we break down and highlight the sort of major trend in that monthly chart, and then we go to the next time frame. That time frame will either confirm that trend or it will reject that trend, and we keep on going on further time frames down until we get to the time frame that we look to trade on. I'm just going to have a drink of water. Let's go to the next chart slide. We're all obsessed with charts, obviously. You may have technical levels that you can see on a weekly chart. This is why it is so important to break down timeframes, okay? So you might have technical levels on a higher time frame chart, i.e. a weekly chart, but you can't see that on a 4 hour chart or a 1 hour chart, etc. So you might have a monthly chart that's got a trend line on it. It's not visible in a shorter time frame. You might have a weekly chart that's got a 161.8% extension on it, but you're looking to buy it on a shorter time frame because you think it's a decent reversal, but all you're doing is buying into resistance. You might have cloud support or resistance on a daily chart, but you haven't seen that because you're trading off a 1 hour chart. Or you might have strong areas of previous support or resistance if you look at a big picture analysis and you want to note where those areas have been that have attracted buyers and attracted sellers, but you won't get to see them on a shorter time frame, unless you've plotted them all on one chart, and then it'll be highly confusing if you're just looking at a 5-minute chart with hundreds of trend lines on it and hundreds of fib levels, etc., etc., etc. And the list keeps on going on, i.e., an evening doji star, going back to that, if it was on a monthly chart, you wouldn't necessarily know that if you're looking at a 5-minute chart. So it's important that we break down different time frames in sequence so we get to know the big picture and our bias from the bigger time frames. And I think this is a great example here. Somebody, and again, we keep on learning. I never knew about A.M.R candles until about 4 years ago when I was introduced to them from a guy that was doing a webinar on FX Street. And an A.M.R candle is an acute monthly reversal candle. So what we're saying there is, if you see these aggressive reversal candles on these higher time frames, don't ignore them. You want to really be then trading with that trend, or your overall picture wants to be with that trend. Okay, it might be an evening doji star, it might be a long-legged doji, it might be a bullish or bearish engulfing. And one great example here, what we've just had, is the S&P 500 or the US 500. This is a monthly chart. We've got a bearish outside month. That is an acute monthly reversal candle. So even if we see corrections, sorry about this, in the index, we all work from home, by the way. If we get a correction in the index, it's likely just to be a correction, even though it could be quite a deep correction. It's likely to be only a correction because that acute monthly reversal candle is likely to hold a lot of power. And God, somebody's got the dog. So here we are. We're going to break down time frames. We've got the monthly chart first. This is sterling dollar. Trending, counter trending, or neutral is what I've noted at the top. And I've noted this for all of these different time frames. So let's break down this time frame. We've got trend line support that's held. It looks to have formed a bullish ending wedge pattern. A break of 133.46 would confirm that, which is the top of the wedge, and the measured move target would be 171.91. We're also noting in this higher time frame, we're noting areas of support and resistance on the way up. Okay, so I would say in this time frame, we're still holding inside that ending wedge, so the bias is mildly bullish, becoming stronger on a break of 133.46. So really at the moment for me, I would be looking at taking long positions in shorter time frames just from looking at this monthly chart. If we go down to the weekly chart, okay, there's not a great deal to take away from this weekly chart. We've got some bullish divergence. What bullish divergence is the chart makes a lower low, or price I should say makes a lower low, and the oscillator, which in this case is the RSI, makes a higher low. Often means that we've overstretched the sell-off and we should at least see a correction to the upside. I would actually call this time frame neutral because we haven't got any reversal candle formations, and the previous third week is a bearish outside candle, which, like we're saying about outside candles, offers some power to the downside. So we've got, if we think about it, we've got a monthly candle, or we've got a monthly chart that's mildly bullish. We've got a weekly chart which is pretty neutral, really. And then we're breaking it down to the daily chart. Now, the daily chart, we've got a cipher pattern. We did a webinar on cipher patterns yesterday. This is a bullish butterfly. In case you didn't get the cipher pattern, or you find them hard to note, what you have got here is you've got a 261.8% fib extension level, which is down here, and we've also posted a bullish outside day. So again, we're looking at those reversal candles and formations. So we've gone from monthly, mildly bullish, weekly, neutral, to daily, showing what I believe is quite a strongly bullish formation. We've got the cipher pattern, we've also got a bullish outside day. And then we break down again. And again, this is the 4-hour chart. You're not always going to walk away with a bias. Sometimes it's a mild bias, sometimes it's just completely neutral. This, we could say that we're potentially, or we have potentially posted a double or treble bottom. We haven't quite broken the upside. And again, they're not my favorite formations. The reason they're not my favorite formations is just basically because you've got to wait so long for the formation to be confirmed, which is i.e. a break and a close above this level. And I think as we talk, cable is actually starting to take a move to the downside. So just having another look, and again, another breakdown. That's a 4-hour chart. We're going to the hourly chart. What we got on the hourly chart was a bullish bat formation. Again, a lot of people will find those hard to find, but if you miss that, then there was another formation on the 1-hour chart, and that was an ending wedge pattern, and we did reach the top of the wedge formation in pretty early trade. So if you miss the bat formation, then there was an ending wedge pattern to highlight a bullish bias. So just breaking it down again, so we had sort of monthly, which was mildly biased, but mildly bullish. We had a weekly, which is neutral. We had a daily, which is bullish. We had 4-hour, which was pretty neutral, and then we had an hourly chart, which is bullish. So we're then looking to not always trade with the trend, but we want to know when we're trading counter trend. And you can also mix your money management up a bit when we're getting into counter trend trades. In other words, you could risk, maybe if you're risking 2% per trade, you only risk 2% per trade when you're trading with the long-term picture, and maybe you only risk 0.5% or 0.75% per trade if you believe from your analysis that you're counter trending. In other words, you're risking less on the counter trend trades. So what sort of time frame should I use? Now, I've pinched this from somebody else, to be perfectly honest. It highlights a trading style. So it basically says that a longer term trader who holds trades for over a day. I don't know many people that, well, we try to hold our trades longer than a day, but so a long-term trader holding a trade longer than a day, they're looking at a weekly trend chart, and they enter the trade on a daily chart. Swing trader, holding period a few hours to a day, and again daily chart for the analysis, and then an entry chart 4 hours. Short term, less than a day, 4 hours, and hourly. Now, again, like I'm saying, I don't know if I sort of believe in this synopsis of what category you should necessarily put yourself into. I suppose myself, if I was to look at this and say, well, what type of trader are you? I'd probably analyze off every time frame, and I'd probably take my trades off these two, which would, on this chart, would make me look like a short-term trader. But I'd like to think that that's where I end up as a long-term trader, because even though I'm taking short-term setups, or I'm taking setups off shorter time frames, I'm really looking at this big picture, and I'm wanting to hold my trades for at least a day. I hope that's sort of made sense. Again, just break down the time frames. Look to higher time frames, look at higher time frames for formations, for trend lines, for fib levels, and then break it all the way down and try and maximize your entry level off shorter time frames. And like I said, 4-hour, hourly time frames, maybe 30 minutes is really the shortest I go down to look for confirmation of a decent setup. Okay, guys, I hope you've enjoyed that. Good luck, and we'll be back again soon with some more webinars. Many thanks.